30, we're going to call the Committee on Audit to order. Madam Clerk, please call the roll.
Commissioner Colleen.
Presente.
Commissioner Garza has requested an excuse. Commissioner Clark Coleman. Commissioner Kniezek. Chair Dobb.
Here.
You have a quorum present.
Thank you. Next item.
B, Chairwoman's remarks.
I have none. Next item.
C, approval of the April 17, 2024 meeting minutes.
Madam Chair.
It's been moved by Commissioner Colleen, supported by Commissioner Clark Coleman. Is there any discussion on the meeting minutes? Hearing none, please vote. Sorry, please. We don't have our tablets today. All in favor, please say aye.
Aye.
Anyone opposed? Anyone wish to abstain? Motion passes. Next item.
D, unfinished business. There is none listed.
The next item.
Item 1, under new business, forwarding a letter from Plant & Moran PLLC, the county's independent external auditor, providing a required communication to the Commission, Committee on Audit, and the county executive on the results of its audit of the county's September 30, 2023 financial statements and related annual comprehensive financial report.
All right, and actually we'll take E1 and 2 together. So if you could read item 2.
Item 2, a presentation by the county's independent external auditor, Plant & Moran PLLC, on the county's September 30, 2023 annual comprehensive financial report and single audit.
I'll turn it over to our Auditor General.
Marcy Cora, Auditor General, and I'll have our guests from Plant Moran introduce themselves and also our representatives from Management and Budget.
Dave Holisek, Audit Partner, Plant Moran.
Harris Lenwick, Audit Manager, Plant Moran. Manju Patnaik, Senior Manager, Plant Moran.
Ramzi Abdallah, Principal, Plant Moran.
Keith Chmielewski, Principal at Plant Moran.
Yogesh Kusani, Deputy Chief Finance Officer, Management Budget.
What you have before you say, this is the results of the fiscal year 2023 audit. What we're going to do is Plant Moran will go through their presentation and go through the findings in the single audit. And then our next meeting, which will either be June 4th or June 5th, we'll have Management and Budget will do their presentation along with the auditees for the corrective action for the single audit findings. So I'll just pass it on to Dave Holisek. Okay.
Thank you very much. So as in the past, the presentation will mostly be driven through the PowerPoint that's presented on the screens here, coupled with really an in-depth analysis or discussion on the findings, both on the financial statement audit as well as the single audit. While we are meeting here today, the audit actually began back in the fall of 2023, with majority of the work really being done in the December through the March time period. Public Act 2 of 1968 requires that the county be audited and file its statements with Michigan Department of Treasury within 180 days of the fiscal year end. And even though we're meeting here today to formally cover the results of the audit was completed in that time frame and submitted to Treasury on a timely basis. As far as the deliverables are concerned, I know Ms. Cora had forwarded to the committee as well as the entire commission. But as far as the financial statement, which was the largest document you would have gotten, really that is the county's document. They compile it, we review it, and we issue an opinion on that document. And we were able to give an unmodified opinion on the ACFR statement, which is the highest level of assurance that we can get a set of financial statements. What that means is those statements as presented fairly reflected the financial position of the county as of September 30th of 2023, and the change in that financial position, the revenues, the expenditures, the cash flow statements, and the notes that were included within the document. There was an emphasis of matter included in that opinion paragraph. It related to the required implementation of a new GASB standard related to subscription-based IT arrangements. There was no modification of opinion as a result of that implementation. In addition to that large document, there was a number of other deliverables, just referred to the required communication to those charged with governance. We have our single audit report, which again, Tara and Manju will step into and discuss a little bit. Aside of that, there was actually 3 additional financial statements that were issued. The Wayne County Land Bank was a separate direct opinion. So while that information was included in the county's ACFR, we did give a direct opinion. It was an unmodified opinion on that statement. In addition, there's the building authority and the sewage disposal system. So those are in relation to opinions. So it's basically just taking the information that was already included in the ACFR, putting together kind of a side report that would just compile the building authority and the sewage disposal system. So there's no additional work that was done other than just pulling that information out of the ACFR and into these separate statements. So on the next page, just as a reminder, these are really the criteria. So we're not giving absolute assurance. We're giving, we're expressing an opinion on the financial statements. We do the testing we do the examination on a test basis. We don't test every transaction, which I know all of you know about, but this just is a reminder of what goes into the opinion and what that opinion means other than what I had previously mentioned. So with that, on the next page, I'm going to turn it over to Keith, who's going to talk a little bit about the timing and the field work.
Thank you. With the next 4 slides, I'm going to briefly discuss the required end of audit communications, which can be viewed as a follow-up to the letter we sent out at the start of the audit to the entire commission, laying out our plan for the audit. That was dated December 1st, 2023. As Dave mentioned, we did begin planning and preparing for the audit late summer, early fall. We proceeded with risk assessment procedures throughout September and October. And then the bulk of the audit work really begins around Thanksgiving time and goes through the report issuance near the end of March. GASB statement number 96 was the significant change in accounting principles that was effective during the year. The county went through quite a bit of effort to analyze the IT arrangements that are in place and record those that fall under the new standard. And we audited those changes and had noted no exceptions with the county's implementation of that new accounting standard. There are 4 significant adjustments that are included in the ACFR. These have been disclosed in the past and have not changed from last year, but because of the sensitivity and the likelihood that there will be some deviations between what's estimated as of September 30th, 2023 and what ultimately takes place, we want to make the audit committee and the commission aware that these are significant estimates. So the county is self-insured for workers' compensation, certain healthcare benefits, litigation, and other claims. So the estimated liability there is based on certain reports from external consultants, as well as the county's internal analysis. The net OPEB for liability related to retiree healthcare and the net pension liability are both based on actuarial evaluations. And there's an estimated liability for property tax refunds and chargebacks, which is based on historical data. We audited each of these significant estimates, the methodology and the assumptions that went into them, and found them all to be fair and reasonably calculated and recorded, which is part of the reason we're able to give our clean audit report. Then lastly, in our end of audit communication, there are a number of topics we're required to touch on. We did identify some misstatements as part of the audit. The county made corrections for all of the material items and chose to pass on some of the immaterial items. But other than that, there were no difficulties encountered in performing the audit, no disagreements with management, and no other exceptions to our audit plan that we need to bring to your attention. With that, I will turn it over to Rumsey.
Thanks, Keith. Before we get into some of the audit findings, we thought it would be helpful to provide a refresher on some of the context on what goes into a reportable condition and what a control deficiency is. So on the next slide, you'll see that a control deficiency is essentially when a deficiency exists in the design or operation of a control that does not allow management or employees when performing their ordinary duties to prevent or detect a misstatement on a timely basis. Now, when you get into control deficiencies, there are really 2 types that would be included in the audit report. The first is a significant deficiency, and a significant deficiency is less severe than the other type, which is called the material weakness. However, it's still significant enough that in the auditor's judgment, it is warranted to be brought to the attention of those charged with governance. In this case, that would be this group here. And then you'll see on slide 10, and moving ahead to slide 11, that's where we talk about the definition of a material weakness. A material weakness is a deficiency or combination of deficiencies that essentially present a reasonable possibility that management would not be able to detect a material misstatement in the financial statements or in financial reporting. So it's really the fact that a material misstatement could take place is what triggers this being a material weakness.
Commissioner Kling.
Thank you. Just to review, there's a hierarchy here of deficiencies.
Correct, yes.
Control is the least concerning,
Correct, yes. Any,
and then significant, and then material is like, uh-oh,
correct, yes.
okay.
And
That's the hierarchy.
yeah, and it is possible to have a control deficiency that does not rise to the level of a significant deficiency or a material weakness. And then in those situations, it could be something where there's a mitigating control or a compensating control that essentially reduces the impact of that control deficiency to be fairly insignificant or immaterial.
Thank you. Thank you, Madam Chair.
Thank you.
So with that in mind, we're going to go ahead and go through the deficiencies that were identified during the audit that are reportable. And then we're going to start with those that relate to the financial statement process and those internal controls over financial reporting. Specific language related to these findings can actually be found in the single audit report. That would be the Federal Award Supplemental Information. And this is the 37-page report that would be included in the audit deliverables. And the first finding starts on page 15. And the first finding is a repeat finding from prior years, and this has.
Hold on just a moment.
Yeah, wait a minute, yeah.
We need to.
Yeah, I'm getting there. I'm trying to,
Just a moment.
see, I started with the front page and then went into the, I've already noted there's 17.
Okay, we all set? Okay, please proceed.
The first finding is a repeat finding, and this has been identified as a material weakness. And this relates to the identification of journal entries during the audit. Keith mentioned during the audit, we did identify multiple accounts that were misstated. The county's general ledger and underlying records were not reconciled and closed in a timely manner. As a result, adjustments were identified during the audit process. The adjustments were reviewed with management, and we worked with management to arrive at the corrected adjusted balances. And those adjusted balances have been reflected in these financial statements. However, had they not been reflected, the financial statements would have been materially misstated. Our recommendation related to this finding is that the county should work with all departments to ensure that each has adequate resources to fully and accurately reconcile and record the activity throughout the year and also at year end. Moving on to the next finding, which is on page 17. This has also been identified as a material weakness, and it is also a repeat finding. And this relates to a lack of an overall monitoring process and procedures over the general ledger and the financial reporting function. So this kind of is tied to the first item where accounts were not accurately reflected at year end. So this sort of goes along with that. And ideally, the county should have a process in place to assign all general ledger accounts to an appropriate person for monitoring and including financial analysis to ensure that those accounts are reviewed timely and are reflected, are reviewed for accuracy and completeness. Moving on to page 18, this is finding number 3. This has been identified as a material weakness and a material non-compliance with laws and regulations. And this is also a repeat finding. So essentially, there are 3 state laws and regulations that we found that the county was not in compliance with. And I'll describe each of those 3. The first one is the Uniform Unclaimed Property Act. So the county is holding road construction and performance bonds on projects that go back many years. Now, upon completion of these projects, sometimes those bonds and deposits are returned to the original person that placed the deposit, and in other times they're forfeited to the county. So the county, again, has deposits going back several decades that have related to projects that have not been closed out. So it's possible and likely that some of those performance bonds and deposits need to be escheated to the state as unclaimed property. So that would be the first law and regulation that the county is not in compliance with. The second is the county had several budget overruns in various funds, and two of the county's funds were actually budgeted as a deficit, which are both a violation of Public Act 2. And then the third law and regulation that the county did not comply with is the county did not prepare a budget for the Building Authority Special Revenue Fund, which is also a violation of Public Act 2. So really, two of the three relate to Public Act 2 budgeting requirements.
Okay, so, sorry, I want, excuse me, I want to go over this one again real quick. So we've got the escheatment on this. We have the budgeting for I've got the general fund, roads fund, and multiple non-major governmental funds.
Yes,
Okay, and then I also have original budget and amended budgets for victim wellness and CDBG funds.
correct.
Okay.
Those two funds, so the first group of funds that you mentioned had budget overruns.
Okay,
And then the second group were budgeted as deficits. So
okay, all right. I just,
had they actually played out to what the budget was, the funds would have been in a deficit.
okay. And the building authority does not have a budget.
That is correct.
Yeah, and
Okay.
really on number one, the thought is Public Act 2 would say money should be appropriated for prior to entering in any agreements for goods and services. So theoretically, when you've got something that's over budget, that means you've, received a good or service, but it hadn't been budgeted for. So it's just making sure to keep that in mind when going through that budgeting process.
Commissioner Khalil.
Yeah, thank you, Madam Chair. I'm trying to follow the bouncing ball here. You were discussing the 3 state laws. Where do we have that in the paperwork that I have?
Those would be discussed on page 18.
Yeah,
And-
okay, because all 3, okay. Because then we started talking about on number 1 that we just heard, and I wasn't sure if you were talking about finding 2023-01 or number 1 in the list of 3 things that we just read about what's, I'm trying to follow.
Yeah.
What exactly we're talking about.
So Dave's comment about number 1 was referring to the budget overruns that are, so within there was actually the second law and regulation that's what that relates to, the budgeting of Public Act 2.
Not the number of the findings.
Correct,
It's-
yes.
In the discussion here.
Mhm,
Well, I'd like to have your comments,
mhm.
because a lot of times to go from a PowerPoint to a verbal report and then get into the weeds of this, it's hard to put everything together.
Mhm.
So I would love to get a copy of your comments here today. That would be helpful in me following what's going on.
Absolutely. We can
Good.
put that together.
Thank you, Madam.
Please
So
proceed.
we're on 3.
So moving on to page 20. And I'm actually going to cover findings 4, so 004 and 005 together. These appear on pages 20 and 21. Both are repeat findings and both have been identified as a material weakness in internal control. And both of these are specifically relate to the cash reconciliation and the treasury function. Finding 4 is specific to inmate property cash accounts that are held in the jail management system, which were not reconciled to the general ledger on a timely basis. So the county's year end, as you know, is September 30th. The reconciliations were completed in February of 2024, so 5 months after year end. In addition to that, while the reconciliations were ultimately completed, there was $600,000 in items that were identified as differences. However, they were not reconciled. The details of those reconciliations were not done. Similarly, for finding number 5, this relates to cash held in the cash receipts fund. The county should have a process in place to ensure the balances are in the fund are properly reconciled. Based on our audit, the county couldn't support all asset and liability accounts within the cash receipts fund. So the effect of findings 4 and 5 is that without adequate and timely reconciliations and procedures in place, the county could fail to identify errors or misappropriations on a timely basis.
For the cash receipts fund, is that for any particular department?
It would be,
I would say it's a combination, Yogesh might be able to, between the treasurer's office and probably M&B. There's a reconciliation, but essentially the activity runs through the cash receipt fund is activity that would normally be generated through the treasurer's office. And that's in the past, when we've had this finding, I believe that's who is taking ownership of trying to reconcile those accounts.
That's correct. Yogesh Kusani and DCFO. Dev, that is correct. Majority of the transactions are being posted by a treasurer's office. So there's some other portions that management budget has that one too. So obviously and again, it's a kind of in a clearing fund, like I would say that's a kind of an internal bank that most of the treasurer's transaction goes to that fund.
Okay.
And to be fair, there was improvement in
Right.
that fund year over year, but there's still further reconciliation that needs to be done.
And also what we are looking in our new Oracle system, I think we are changing the whole process for that reconciliation of 999. There might not be a 999 fund, but there could be a direct reconciliation with the cash management system of an Oracle. So that definitely will be looking for some improvement.
Commissioner Kling.
Yeah, thank you, Madam Chair. I'm trying to, what items I really want to get into gory details here in more of an overview, but that we're doing here, but finding 4, 2023-04, page 20. This is saying that the county is saying that the reconciliation of inmate property cash account, that we're keeping 1.4 million in that account, but we can only account for 783,000 deposits by inmates.
correct, yes.
I'm not sure what the effect of that is, Madam Chair, but we might want to hear from the sheriff on that if they can't support an additional 600,000, or if it really is belonging to the inmates. How deep into the questions I want to get here today.
Yeah.
But we'll have a chance to go over the single audit report with the individual departments. Is that correct? And they'll be here.
And
I got some stuff I saved then. I'm gonna hang on to some
So
stuff.
Commissioner Colleen, I think the question that you'll be asking on this one is what sort of process is in place to reconcile the cash account to
Oh, yeah.
liability balances?
Well, as you say, we've seen this before.
And we've
This
seen in
is
the
not
past,
a-
where the numbers actually flipped the other way, where the balance was higher than the
Mhm.
balance that looked like was owed was higher than the cash balance. So that somehow as part of
Now we
the
flipped it.
fix has been reconciled. Now it's sitting the other way. So this is one of those things while you're looking at it, and we don't like to talk about materiality too much. Because I mean, the numbers itself, as we typically took a look at it from a countywide basis, isn't a significant number, but we're talking cash. So that's why we end up here.
Well, from my perspective, not only as a member of the audit committee, but as a member of the county commission, it's bad enough you gotta spend a little time in county custody, be housed by the county for a certain amount of time, and for there not to be an accurate amount of cash when you leave that are reflective, right? Well, we don't need to double, triple, quadruple punish people because of bookkeeping. So that is a real part of my concern here, as well as all through, that we get this right. Vulnerable population, they don't need to get more hits. So I'll wait a little bit more on that. But yeah, and this is a repeat finding, as most of these are, right?
Right.
And so we've seen this one before for 04. We're in our 4th year of that finding. And like you say, it's flipped back and forth, but it hasn't gotten right. 4 years. Thank you, Madam Chair.
With that, I'll hand it over to Keith. Keith's gonna
Be-
cover.
Before we move on 03, if you don't mind.
Yes, please.
Ms. Cora passed me a note just to clarify. The one item at the bottom included in here, as far as the violation is, there are budget amendments including included in the
where are you
financials.
speaking?
I'm back on
03.
page 18.
There we
Sorry.
go. You got to give elected officials
I'm
page
sorry, I
numbers.
apologize. In
Give
my
us page
mind, it's
numbers.
making sense. But there are budget amendments included in this financial statement document where the budget amendment actually happened after the fiscal year was completed.
Okay.
So, we had, when that was happening, we had a discussion on that and you proceeded to do that. But again, that wouldn't be consistent on a number of levels to have the amendment happen after the fiscal year closes. So that Ms. Cora asked me to clarify that as well. Ultimately, I understand that you need an amendment to appropriate the funds.
Mhm.
We've got a reporting requirement to just let the reader know that happened after the fact.
Commissioner Clean.
And that change will appear in next year's audit.
No, it changed, the amendment is in,
It changes the numbers for this year.
The
but
amend-
you did it in a different fiscal
you
year.
did it in you amended I'm sorry, the county amended the 2023 budget. September
I
2023
did. I voted.
in late 23, and I don't even know if it went into January of 24. It was 3 to 4 months after the year
Yeah.
was complete.
And that doesn't get picked up in next year's audit as well?
Well, no, because it relates to the 23 activity. It'll show up next year if there's a similar
Okay.
course of action, related to
I'll
the
leave
24.
that be. I'm not sure
Okay.
of the accounting. Okay.
All right, let's move on.
Okay, I'm gonna pick it up with finding number 6, which is on page 22. This finding relates to Gatsby statement number 84, which was first effective 3 years ago and required certain activities previously recorded in fiduciary trust and agency funds to now be recorded in the general fund because it's considered county operations. When that activity was in the trust and agency funds, cash and liabilities were always equal. Whatever cash was on hand was inherently owed to another party. As part of moving nearly $29 million to the general fund this year, we began to audit and investigate who that money was owed to and look at support for the balance. The county was able to provide support for about half of the amount, but another $15 million could not be easily substantiated in time for the audit. So that's not to say they're not legitimate liabilities, but some additional work will have to be done to reconcile the balance to the specific parties that are owed. Moving on to finding number 7 on page 23. This is a repeat finding, but classified as a significant deficiency, and it relates to the undistributed tax fund. In this case, we noted that the county has made significant improvements in reconciling the larger balances within the undistributed tax fund, but some of the smaller balances within the fund haven't changed from year to year or haven't been reconciled for fiscal year 2023. So we recommend the county continue progressing, moving on from the larger balances that have been properly reconciled to addressing the smaller balances in that fund as well. Finding number 8, still on page 23, is a new finding in 2023 and is classified as a material weakness and relates to payments made to other taxing authorities. In this case, we noted a specific issue in which $7.4 million was paid to incorrect taxing agencies during the year and was still with them as of the time of the audit. So the fact that this took place inherently tells us that there are needed improvements to the processes and controls to ensure something like this does not happen again in the future.
And, excuse me, and this one is a new, thank you. This is a new finding,
Correct. We have not noted issues specifically like this one in previous years.
Okay. Commissioner Clean?
Is this where? Is this a transaction, when you say other taxing authorities? We're talking the 43 communities in Wayne County?
Could be the communities or some of the authorities like the Zoo Authority and the
Yeah.
Arts Authority.
Does this refer to, our arrangement with the tax delinquent revolving fund? That we take the debt off of local communities, pay off their property taxes, and then we do the collection? Are those
Not this
payments part of
particular
this?
matter. No, this would be separate.
Can you characterize then what these payments are? Not in gory detail, but just what are they?
These payments would have been, these would have been payments that were collected by the county. Mostly related to ISD, SET,
Right,
those
you're
type of
using acronyms.
intermediate school district, state education tax. None of these that we're talking about were the local units of government, not your cities, townships, and villages. So when the monies had come in, they're dispersed and they ended up getting settled. And as of September 30th of 2023, there was still some dollar amounts that needed to go back out to these taxing authorities. But when they went out after September 30th, because, we look at them to justify, ensure that the liability is correctly reported, we noted that those payments went out, in some instances to the incorrect taxing entity. So for instance, and I
To the
can't
tune
say
of 7.4 million.
7.4 went out and, some were overpaid, some were underpaid. And that reconciliation, after we identified it, the treasurer's office is going to work their way to rectify it. So, as of September 30th, the monies were owed. After September 30th, when they went to settle, the incorrect amounts went to those units. So the treasurer's office is working on rectifying that. But there was a control in place that allowed those to go out in the incorrect amounts.
And that will be in their corrective action plan?
There should be in their corrective action plan what their remedy is going to be.
Thank you.
All right.
Finding number 9 on page 24 is the last of the financial statement audit findings. It is a material weakness and is new for 2023. This relates to the cutoff of expenditures, which is the process of reviewing invoices, particularly those received near the end of the year or after the end of the fiscal year, to determine in which year the goods or services were received and booking the expense to the proper year. So this is a process the county has to go through every year. It's tested as part of the audit. In recent years, we haven't had any exceptions, but we did note a couple this year in which expenditures were not allocated to the proper fiscal year based on when the work was performed or the goods were provided. So we simply recommend that the township the county strengthen its processes for reviewing these invoices at the end of the year and ensuring they're booked to the proper fiscal year.
Okay.
With that, I will turn it over to the single audit team to discuss the findings related to that portion of the audit.
Thanks, Keith. The single audit findings start on page 25 of the report. Just a quick overview, the county spent about $263.3 million of federal expenditures during the fiscal year. And we, based on the rules that are applicable, we audited 5 programs. And that made up about $220 million of those expenditures. We identified 8 findings. And the first finding starts on page 25, which is finding number 10. During the course of covering these 8 findings, Tara and I'll be referring to either uniform guidance, which is the overarching guidance that's applicable on federal expenditures, or specific guidance that's been put out by the funding agency. So finding number 10 impacts the Emergency Rental Assistance Program. Uniform guidance basically lays out that the county needs to have certain controls to ensure that the schedule of expenditures of federal awards, or the CFA, is complete and accurate. During our testing, we identified 2 instances wherein both the general ledger as well as the CFA needed to be adjusted. Both instances, the general ledger and the CFA were lower than where they should be. One was for $550,000 to record beneficiary payments, and the second was for $160,000 to record for activity that had happened subsequent to year end, but related to fiscal year 23. Both adjustments were made, and we recommend that the county continue to review activity and ensure that it's properly being reflected both within the general ledger as well as the schedule of expenditures of federal awards. Moving on to page number 26, which is finding number 11. This finding also impacts the emergency rental assistance program. So uniform guidance does say that when the county is passing through funds to subrecipients, there needs to be a risk assessment policy in place. Basically, the risk assessment policy assesses the risks associated with these subrecipients who are receiving federal funding and allows the county to determine what level of monitoring needs to be performed of these subrecipients when they're spending the funds. The county does have a risk assessment policy in place and is in compliance with uniform guidance. However, the county's policy also talks about performing risk assessments of potential subrecipients before the county enters into agreements with these subrecipients. So with regards to the emergency rental assistance program, we found that the county was not in compliance with their own policy. So the risk assessments were not performed before entering into the agreement. So we recommend that the county continue to evaluate your policies to ensure that you're in compliance with the applicable rules and regulations, but also county continues to be in compliance with your own policies as you're implementing processes.
Okay, Commissioner Khalil.
Thank you once again, Madam Chair. So the county gets a federal grant. And then we have a half a dozen nonprofits that we want to spread it to. What consists of a risk assessment? What is the assessment? And what the county has a policy for it. Maybe haven't been using it, but what's involved in that risk assessment? What are they looking for with these subrecipients?
The county.
Or what's the federal government looking for?
The federal government doesn't outline what kind of risk assessment.
Okay,
needs to
this
be
is just
performed.
an accounting.
The county is required to perform risk assessments. How the county performs the risk assessments is all dependent on the county and how they want to do it. That's not provided by the federal government. And the county has a policy around it based on the dollars that they're providing to subrecipients, based on the subrecipients' audit results, et cetera.
Well, I guess I'd like to ask Mr. Gasani then, what's involved in our risk assessment? What are we looking for to determine whether this is a party that's too risky to deal with? What's involved?
So Commissioner Kleen, yes, so our personal department get involved as well as our grant compliance, grant director. So it works out between the combination of these two department. So when they do a risk assessment, obviously they get all the data. And again, I don't know the details behind that. But when they decide, who is the either vendor or subrecipient, they look at their contract compliance, their history profile, and so forth. And that's what the detail is listed in their risk assessment.
Do we look at their books?
I do not believe so at this point, but I can check it out.
Yeah, I'd be curious as to what the bar is for us to turn over taxpayer money to someone. The assessment, we don't want to turn it over to folks that are,
But Commissioner,
gonna
this
in
was
one
like
way
a-
or another just burn the
this was a
dollars.
new program, emergency rental assistance. So we were giving some money to the, individual who are suffering, who cannot pay rent. And then we ended up paying their utility bills, all bills, which we were directly paying some of the DTE. So there were a lot of nuances involved in this operations. Actually.
Okay, because we're gonna go over this again, right?
Yes.
So, but I wanted to kind of hear from the auditors what
In Manju, if you could.
you've seen
clarify.
other organizations and other risk assessments being done,
So-
but since it's not a federal requirement, okay, I
Well,
get it.
But in a subrecipient relationship like this, Manju, if you could clarify, part of that assessment in a subrecipient relationship is going to be the requirement for that subrecipient to receive the money, to actually have, as long as it's more than 750,000, they're going to have a single audit
Right.
requirement as well.
Mhm.
So
Okay.
I believe the risk assessment is almost monitoring
Exactly.
what those requirements are and how good, that subrecipient is as far as
Okay.
complying with the laws and
Okay,
regulations.
that's helpful, yeah.
Yeah,
that's-
that's
And
correct,
it's
Dave.
going to be, obviously it's the county has a plan that dictates specifically what that analysis would require. The finding is you've got the policy, but the performance on the county side to evaluate that has not happened.
I got you. Okay, that's very helpful. Thank you, Madam Chair.
We'll move on to finding number 12, which is on page 27. So finding number 12 relates to the coronavirus state and local fiscal recovery funds. The county entered into an agreement with Drains for $10 million and passed through the funding to Drains with this $10 million and treated this as an obligation that has been met. Treasury has required that the county report all obligations to the to Treasury every quarter. And so as of 9/30/2023, the county did report to Treasury that this $10 million agreement between the county and Drains is considered an obligation, which is considered to have been met. However, when you look at the definition of what an obligation is within uniform guidance, this relationship between the county and Drains does not constitute an obligation. So in this instance, the report that was provided to Treasury confirming that an obligation had been made was incorrect. So the county has taken up a recommendation to ensure that going forward, reporting to Treasury does include evaluating all relationships and ensuring that they meet the definition of an obligation before reporting them to Treasury. Finding number 13, that's me. Finding number 13 is on page 29. This one also impacts the coronavirus state and local fiscal recovery funds. So uniform guidance basically says that when you pass through funding to a subrecipient, there are certain required disclosures that need to be made between the county and the subrecipient within that agreement. They're all outlined within uniform guidance. The county did enter, and the point of including this information in the agreement is to allow the subrecipient to understand the funding that they have received, how to spend it, what are the applicable rules and regulations, and also understand that they are responsible for compliance, and therefore those dollars get added onto their schedule of expenditures and subject to a single audit. The county did enter into several agreements with communities with the coronavirus state and local fiscal recovery funds. However, because of how Treasury defined this particular spending, which was made under the revenue loss category, it did not constitute a subrecipient relationship with the communities. And as a result, the communities received funding with the understanding that they had additional responsibilities being delegated to them under these agreements, which was not the case because of how these funds were passed through. So the county, we have recommended that the county actually continue to review these relationships and ensure that agreements properly reflect what the relationship for these dollars are.
So Manju, if I can just clarify so this finding and the previous one, we're talking about, CSLR. We're referring to as ARPA money. I mean, just so that's what I think most of us are referring to. On this particular one, I want to be careful because we don't want to step into the local units' shoes and say how they interpreted it. When we were reviewing the agreements between the county and the local units here, I think when we read it through, it was not clear if there was a federal requirement or not. And I think that's really what our finding here is, to clarify the language to the recipient, in this case, the city, village, or township that the county's giving money to, so that the entity that's receiving it fully understands if they've got a single audit or, a federal compliance audit, that they're required to do as it relates to the receipt of these monies. So I want to be careful. We're not stepping in and saying that they did interpret it that way. Our reading would be unclear if a recipient could come to that conclusion. And the risk there is, if they're not subject to it, and they do it, there's a cost, obviously, to perform a single audit, and it'd be really potentially, filing a CFA that would actually not be correct because it wouldn't be federal dollars at the local level. Again, not saying that's happening, but that's why it was significant enough to bring it up in this manner.
Madam Chair, can I request, I have a Director of Grants online, Santika Bullard, and she would like to speak about this drain transaction.
Okay, so we're going, excuse me, we're going back to the drain item.
The last,
That was,
the finding was,
which number was that?
Number 12.
Finding
number
12.
Well,
Wow.
okay. She's on Zoom.
Santika, go ahead.
Can you state your name and title for the record?
Good morning, this is Shantika Bullard, Director of Grants, Contracts, and Compliance Management.
Shantika, you're very quiet. Is there any way you can speak up or
Is this any better?
a little bit?
Okay, I wanted to address any questions that came from the finding. I didn't hear any questions specifically that came from the finding. So I would just note that the relationship with drains as a component unit but separate legal entity was reevaluated and updated, and that update has been made with Treasury.
Okay. All right. Do we have any questions on that? Okay. All right. Thank you very much.
So Tara, I'll cover the next 4 findings.
Thank you, Manju. So these are the last 4 findings. They're still within the federal program audit findings section. So beginning on page 32, finding number 14 is a repeat finding. It relates to the supplemental nutrition program for women, infants and children, so the WIC program. Under uniform guidance, any situation where a grant recipient works with a third-party contractor to administer the program, the third-party contractor really cannot independently be making significant programmatic decisions for that federal program. And so in this situation, where eligibility determinations, both at the intake and the ultimate eligibility certification, was being performed by a third-party contractor, the county did not have oversight over those decisions. And so our recommendation here is that the county implement a set of controls to ensure that there is a review that occurs at the county for these eligibility determinations of the program participants. And then on page 33, finding number 15, this one also relates to the WIC program as well as as well as the CDBG block program, or the community development block program, and the child support enforcement. This is a repeat finding as well. So the requirement here is, or let me start with context. So the county has several indirect cost allocation plans that it is required to submit to a federal cognizant agency for its approval on an annual basis. This finding relates to two of those plans. And so so specifically, the self-insurance cost plan as well as the annual chargeback plan were not submitted. Actually, beginning in fiscal year 22, the reason this finding repeats is because that submission needs to happen before the fiscal year begins in which the costs are going to be allocated. And so because that submission did not happen for fiscal year 23 as well, we end up with the repeat. We were able to see that for fiscal year 24, these two plans have been submitted for cognizant agency approval. Moving on to page 35, finding number 16. These last two findings relate specifically to the CDBG program. Finding number 16 is a new finding. So this is, we've classified this one as a significant deficiency. So the county is required to submit an annual report referred to as the Consolidated Annual Performance and Evaluation Report, otherwise known as the CAPER. And this report is due 90 days after the end of the program. So not following the fiscal period, the end of the program would be June, therefore the due date is October. And the report in October 2023 was submitted about a week late. And we understand from the county that there is already corrective action in place to ensure that the October 2024 report will be submitted within that time frame. And then the last finding on page 36, so finding number 17. So the county is a direct recipient of CDBG funding, and in situations where the county works with subrecipients when they receive funding in a direct funded situation, they're required to report essentially any sub agreement or sub award that they enter into. They need to submit a report and report that agreement within 30 days of entering into that agreement. And that includes new agreements as well as any amended subrecipient agreements. And we noted during our testing that there was one instance that the sub-award was reported 7 months after this 30-day requirement. And so we understand as well in a situation that corrective action should be in place for fiscal year.
If one of you could real quick, so we've talked on the single audit findings, but we didn't test every single audit grant program. So maybe if you could just talk how many we tested and why we only tested that many.
Yes, so the county does receive funding from several funding agencies, both direct funding as well as pass through other non-federal entities like the state. Uniform guidance actually outlines how auditors are to determine what programs to test. And in order to do that, first we have to determine a threshold, which is based on your total expenditures. And the county's total expenditures were over $100 million. So we had to identify programs that were $3 million or more. And then once we identified those programs, we are required to do a 2-year look back on these programs to determine, A, did we audit these in the past 2 years? And if we did, what were the results of the audit? If the results of the audit were clean, those get termed as low risk programs and we're not required to pick them. And then if we did not audit them, or we audited them in the last 2 years, there were material weaknesses, or the funding agency has put out that the programs are considered higher risk and they have to be a part of our testing, those would not result as low risk and we are required to test them. So we identified 5 programs based on that analysis that we were required to test. And those 5 programs are the WIC program, which had a couple of findings, CDBG, which had a few findings, the Emergency Rental Assistance Program, the Coronavirus State and Local Fiscal Recovery Program, and then the Child Support Enforcement Program.
So, Madam Chair, I think that's all we had as far as prepared comments, but we'd be happy to answer any questions that, on anything we may have covered or anything we didn't cover as of this morning.
Any last questions for commissioners? Overall? And just a reminder, we are going to have the departments back to go
Yeah.
in depth.
Trying to keep that.
Yeah.
Burning question. Be ready.
Okay. All right, Marcy?
Could just add, I wanted to take this opportunity because I know Plan Moran will be at the next meeting to thank them for all their efforts in getting this audit done. It is a massive audit to complete and have it completed by the March 31st deadline. It also takes cooperation from management and budget led by Yogesh's team, Michael Bridges and Shantika. So I think they work together as a team, M&B and Plan Moran were able to get it done on time.
Yes, thank you
So
so
thank
much. We appreciate it. All right. If there's nothing else, I'd like to take a motion to pass for the day. So we can continue this
Right.
on. Okay.
I will move to pass this for the day.
Okay, it's been moved by Commissioner Clean, supported by Commissioner Clark Coleman. All those in favor, please say aye.
Aye.
Aye. Anyone opposed? Anyone wish to abstain? Motion passes. Next item, Madam Clerk.
F, such other matters as may be properly submitted before the committee.
There are none. Next item.
G, public comments.
Is there anyone here who wishes to make a public comment? Anyone on the phone or on Zoom? Did we receive any emails?
No emails were received.
Anyone wish to address the Committee on Audit today for public comments? Last call for public comments. Next item.
Adjournment.
Is there a motion to adjourn?